let's go to metals, shall we, quickly, and look through our 5 focus here on a daily basis. This is that's on 0.50. Gold is trying to get lay his hands back on $2,000 an ounce. That hasn't been possible over the last couple of sessions. 0.06%. Looks like investors are getting a little bit more get a bit more comfortable, so they're moving more into riskier assets, but keeping one permanent eye on gold and his main rival, silver, 2870, up by 0.39%. But that's your copper there, 1.14% in negative territory for today, 3.027 per pound. Platinum, a strong 1.55%, and aluminum 1,801. Now, if you look at this 3 metals or resources, you know what that means. You know, they're all part of the story of a PMI, which the US PMI came in strong today. Yesterday, the Chinese authorities reported their August PMI as well, slightly above 51 reading. It looks like the fears that the coronavirus would damage the global economy more than expected seem to be tapering. But the question is whether that cautious optimism applies to emerging and frontier Africa as well. We want to have this conversation with Sina Olubu, who is an economist and policy analyst, and he joins us now from Edmonton in Canada. A good afternoon to you, Sina. It's good to have you on the program.
Good afternoon, boss. And how are you doing today?
I'm good. Thank you. Looking at the various economic data released in the past 6 months, do you think the impact of COVID-19 on Africa will still be as brutal as initially predicted in Q1?
Okay, so, the impact can be looked at from 2 angles. So my answer would be yes and no. No in terms of the health impacts. So the health impact has not been as feared. It hasn't been as we thought it would be in terms of the health impact. And the reason for that is not really far-fetched. So from the numbers we're seeing, the number of cases and the number of fatalities that we have seen in Africa shows that it's not as bad as we thought it would be. And the reason for that is, one, Africa happened to be one of the few last places where the COVID-19 got to. So to that extent, many of the African countries already had an idea of what to do and what not to do. Majority of the companies like the US, Canada, and the rest are being used as guinea pig. So everybody knew what to do and what not to do, and they also had the time that was enough for them to prepare and to close borders. And also, if you look at it from the viewpoint of the fact that the economy in Africa is not as open as these other countries, right? So because of that, it wasn't badly hit as one would have thought. So it's not because we had in Africa had this health infrastructure that was able to deal with this pandemic. It's just that more preventive measures were taken, meaning that because Africa cannot deal with escalation. So if countries like the US, the UK, Canada's of this world will be brought to their knees, regardless of the strength of their health infrastructure, then you can tell what would have happened with Africa. So on the flip side, in terms of economy, I would say the answer is yes. I think that the based on the numbers that we have seen, even though the numbers might not look as damning, I think the numbers are not really that good. The Nigerian economy, for example, in Q2 tanked by 6%. The South African economy tanked by more than 30%, came down by more than 30%. I mean, that's huge. So, and without talking about other African economies. So, and the reason is not really far-fetched at all. If you look at the fact that we have huge black economy, meaning that when we close the economy and so many things were not happening because most of our people operate in the informal sector, what I call the black economy, economies these activities that are hugely cash dependent. So as opposed to countries like the US, the Canadas of this world, where a lot will be done with card and the card numbers and whatnot, right? Even though the digital space in Nigeria is growing, there's still a lot in terms to be done in that. Also, because the economy in Africa seems to be there's a huge chunk of our people that are still unbanked. So Nigeria, for example, has about between 60 to 70 million people who are still not banked. That accounts for about 40% of the population. And Africa is even more damning. Africa is very close to about 80% of the population that's still unbanked. So meaning that when the economy was closed and people could not go about with cash there and here and there, so they could not do transactions. Also because most of our people live on daily earnings, right? Because they live on daily earnings, they also could not do a lot of things. So incomes were down, people could not purchase. That had spiral effect on other productive aspect of the economy, which is why we see that those things that. However, I would say that because economic numbers are usually time lagged, we have not seen the full effect of COVID on economies yet. I see that the numbers in the coming weeks or months might even be more damning when the effects of some of the things that we're saying will be kicking in. So I think that we would see a lot more in that regard. The last thing I would say again, before I allow you to come in, is that remember also that the economy of Nigeria and other Africans are dependent on mono products and their primary economy, whose demand are derived demand. So what is happening in developed markets especially affects them. So if the economy of Canada is projected to drop by 8%, if I think America also is projected to drop by 8%, the world is projected to drop like say by about around the same time, right? So and the UK economy is projected to drop like maybe between 10 and 12% or thereabout, and Nigeria is projected to drop by 5%. So and these are companies that are supposed to demand for our oil. So if production is dropping in them, the effect is that demand also will drop, and that's going to affect the economy of Nigeria and the rest of Africa. So I think that it's huge.
Yes, but look at the investment and the financial markets in sub-Saharan Africa. What's your outlook under the pandemic period?
So under the pandemic period, one would think that it's supposed to be very damning, but again, it will not be damning. I will tell you why. The Nigerian market, so to speak, is too attractive for investors to take their eyes off the market. So, and very attractive, two things. One, the many challenges that we have, call it the space that is not yet fully digitalized, call it name the infrastructure that is very archaic, and we have so much gap in our infrastructure, the road network, bridges, and whatnot. These are challenges for sure, but these challenges are seen as opportunities by would-be investors. So these are things that, because for example, if you are coming as an investor to come to some advanced board to bring some of these things, there's no space for them because such gaps don't exist because things have been done already in those areas. So these challenges will always be appealing to investors. I must say, however, that the environment will need to be more enabling for that to happen. That's the first thing. The second thing I would say is that the returns, the kind of returns that the Nigerian market and other African markets give is too juicy to be ignored. In fact, those returns more often than not compensate for the risk you are taking by investing in those markets, in those emerging markets. Right now, if you look at developed economies like America, the UK, Canada, risk-free instruments, for you to get returns on them, it will be between 1 and 1.5%. Well, that would be the risk-free instrument, right? But if on the flip side, you come to Nigeria, so many risk-free instruments still give you as double digits. In fact, the monetary policy rate is about 12.5%. So, I mean, which is the benchmark rate for every other risk-free stuff to take a cue from. So that gives you an idea of what's gonna happen. So the space will remain attractive also because the monetary authority wants to make sure that inflation is kept under check. So, and as long as you have your ball on inflation, you want inflation to be kept under check. You want to attract hot monies as much as possible. You want to make sure that you keep the interest rate attractive for would-be investors.
Okay, so if we begin to look at the sectors or subsets of the continent's financial markets, is there any part of it that you're especially worried about?
Oh yeah. I'm particularly worried. I mean, there's quite a number of them, but the one that comes top for me is the oil sector. Anytime I look at that oil sector, my world, it's usually very scary to me, and I'll tell you why. A number of factors actually. The first reason is that scary to me is the features or the nature of that market. One feature of the market that I think is that is usually very scary to me is the fact that it's volatile. So volatile because it is exposed to political wranglings, like we saw in a few months ago, where there was price war between Russia and Saudi Arabia, and that led to the oil price coming to as low as $1 to zero to negative, right? So also, another reason is it is hugely dependent on the demand for that product is derived demand, what we call derived demand in economics, where the demand for that product is dependent on whether the demand is made for other products. So, and in a pandemic situation like this, where people travel less kilometers, where borders are closed, which means that aviation fuel will not be demanded for. I don't drive as much as I used to during this time, which is the same thing with other people, right? So, and the less of travel that we make, the less of oil that we consume and products, food that we consume and gas that we consume, and that affects the raw material places where we demand for those things. As long as those things don't happen, as long as we don't travel as much, then we don't demand for that. And of course, that cascades to other aspects of the economy. Then also, the unfortunate thing is this side of the economy, this oil sector, other part of the economy take their lifeline from this oil sector, right? Then the two other reasons why I fear so much for the oil sector. Two other reasons. The first reason is that there is so much advocacy towards cleaner energy. So meaning that so much is being done, so much research is being done to make sure that we move away from oil. So meaning that every day there are new discoveries. People are making inroads into other cleaner energies to make sure that less of oil is consumed. That's why we have electric cars and whatnot, right? So, so these are things. Yeah.
My apologies. There's one particular point of this conversation I want us to touch before our time runs out. How much more would you like to see happen on the side of monetary authorities in sub-Saharan Africa moving forward? Where would you want to see things move? Exchange rate, interest rate, price stability? What would you want to see get done?
I mean, unfortunately, there's usually a difference between the ideal and reality. So the ideal thing for me, first of all, I think monetary authorities in Africa, especially in Nigeria, they deserve a lot of commendation. They need to be applauded because over the years, I've seen paradigm shift from monetary authorities having a combination of the primary role of monetary authorities and combined with that of fiscal authority. So you see them, because ideally monetary instruments are supposed to be for short-term stability. But we have seen the MPR being used to deal with long-term problems, right? So in my view, I think that even though they can still do a lot more in that regard,
yes.
but I feel strongly that right now, it's not. I would love for the rate to drop, but the conditions around the monetary authority do not allow the rate to drop.
Well,
so I would say that they need to collaborate more with the government and fiscal authority. That's what I would say.
Sina Olubu, thank you so much. It's been an interesting conversation. Economist and policy analyst out of Edmonton, Canada. Thank you very much and do have a great day.